Welcome to Key Points for December. This month, our take on the tariff truce, our view on a slightly more dovish-sounding US Federal Reserve, and what all of this means for financial markets through the end of the year. Now, turning to our first point, the outcome from the G20 meeting between the two presidents, Xi and Trump, has been good. The meeting was cordial, it was constructive, and most importantly, there was an agreement reached to suspend the imposition of further tariff hikes on the 1st of January. Now, a lot is left to be done. The idea is that over the coming 3 months, the two sides will have to work on the broader issues about opening up markets, about the actual levels of trade going forward, and the protection of intellectual property rights. So a lot still to be done in the 3-month period, this window that they've bought before tariffs are scheduled to move higher. But this has been a good thing, I think, for markets. De-escalates what had become very much a bilateral trade war between the two, tit-for-tat trade sanctions coming through. And therefore, we think this dialogue is opening up a more calm period and a more constructive period, both from an economic perspective, but also a financial market perspective. Now, turning to our second point, there's been a lot of press about a more dovish-sounding Federal Reserve. Chair Jay Powell certainly has said interest rates are close to a neutral level, meaning a level that is neither stimulating nor contracting the economy, and that's been taken well by investors. Now, this is because back in October, he implied that there was quite a long way still to get to that neutral level, and this appears to have changed somewhat. Now, we see this as very constructive because, as most of you will know, we've been concerned that the US economy in 2019 will be slowing. And certainly the 9 rates that we'll have had, the 9 rate hikes by the end of December, has certainly had an impact on the economy. Remember that the balance sheet is also shrinking by $50 billion a month. And we're seeing slower housing starts, we're seeing slower existing home sales, and it does appear that the higher rates are impacting people's willingness to spend on big ticket items, whether that be cars or homes. So still a good environment, but we do think that we're getting to a period where the Fed can pause. Certainly inflation has just ticked down a little bit below their target, so they've got time in their hands to wait and see how these rate hikes and the shrinking of the balance sheet will play out in the months ahead. Now, to our third point, we had believed that financial markets, particularly equities, had become oversold through October and into November. And I think the removal of some of the stress around the trade environment and a more dovish-sounding Federal Reserve that will still be data dependent, I think will allow markets to move a bit higher. Certainly credit markets also, we had seen spreads widen a bit too much. We still don't like credit terribly much, but that could hold in, I think, a little bit better going forward through year end. And the equity markets, we think, can move higher given the lid that has been taken off them in terms of some of these big issues. It will still be lumpy, it will still be challenging, but we do see upside ahead. Remember that you can get the full details of this report on our Investment Insights publication, available with all our other products on zurich.com/MSME.